Hi everyone, welcome to our market talk. So Raphael, Ted, and I we have a lot to discuss with all the things that are happening in the world and the markets that are actually sending mixed signals. So let's start. Ted, it's been a while. So what can we learn from all these things that are happening in the world? What is going on, and what are you expecting?
I think I can answer that question, huh? That's a big one.
Yeah.
What a difference 40 days makes since I was last on the show. I think at the time we were having opportunities to sell into strength. We were looking at maybe bonds were going to work for us, and here we are with a new world starting February 28th and a different portfolio structure. So let me kind of rip through my presentation here. When bottom? I don't know. 6,100, 6,000. I'll touch on regime as I always do. Talk a little bit about policy. And right now, from my perspective, the only policy is that really matters is the guy in the White House flip-flopping all around, sending all kinds of different signals. I'll look at what market signals I do have and whether they're valid or not. And then we'll talk a little bit about positions and trades. So on the 13th of March, my primary macro service flipped from reflation to inflation, inflation being growth down, inflation up. And I had spent the previous 2 weeks really starting on or about the 1st of March, really, not necessarily unloading, just managing risk. Lots of stops being hit, lots of stops being hit, having to reposition my portfolio pretty dramatically. Just looking at some of the indicators, though, there that in terms of macro indicators, it's somewhat mixed. And in fact, recent data looks. Whoops, am I still sharing screen? Yeah. Okay, hold on. Recent. Yeah, hit the wrong thing, guys. Sorry about that. All right. So recent data has actually showing some strength. Initial claims came out today, 202,000. That's down. High yield credit spreads have actually come down since their March 31st peak and are now at 3.16%. So that's elevated relative to earlier in the year, but really there's not a lot of stress in credit spreads, which should give us some relief, or maybe we're just waiting for the next shoe to drop. JOLTS job openings, on the other hand, which is sort of a forward indicator, those have been declining, and last month dropped down fairly low. SLUICE is just a quarterly number. ISM manufacturing came out yesterday. New orders have been above 50 since the beginning of the year. So there does appear to be some level of manufacturing renaissance of some sort taking place in the US. ISM new orders through February showed some resilience. So we're continuing to see at least some of these indicators, these survey indicators, giving us some signs of strength. On the other side of that, payrolls are down. We do have a payrolls report tomorrow. Of course, the market's closed, both the stock and bond market. So, what are we? I'm not sure exactly what we have as far as what's coming, but it doesn't seem particularly like it's going to be particularly strong. None of the indicators are suggesting as much. So none of these indicators are really current. There's nothing since the end of February. Productivity came out revised at the 1.8% for the quarter ending December 31st. That slowed pretty dramatically. So that's not a good thing. That said, retail sales were up. Retail sales for February came out yesterday, 3.7% year over year. So relatively strong there. And then, but GDP now continues to kind of show some contraction. And of course, GDP, which printed at the end of December, shows 0.7%. So just above break even. On the inflation side, the five-year break-even inflation rate is steady at around 2.55%. The five-year forward at 2.07%, but that's slightly down from where it was in November, December, January. So not showing, at least on the forward outlook, as being anything problematic. Trueflation, which I've moved up to a leading indicator, it's more of a real-time indicator, but these guys reported out, at the end of February, we're at 0.78%. That jumped a full 100 basis points to 1.73% at the end of March. And then their Trueflation report from yesterday actually showed a decline in inflation. And it had to do with a lot of price data coming in, but it also suggests that services inflation is not, even though we have oil inflation, oil at what, closed today at 111-ish, is driving some near-term inflation. There does not seem to be any kind of inflation really flowing through in a big way yet. CPI, these are all old numbers. Fed works with February numbers. We don't even have a February number yet for PCE, so I'm not going to spend any time there. But they're elevated. They're not at target, so at least we have kind of that situation. As far as policy is concerned, right now it's from my point of view, I think from you guys' point of view as well, it's Trump's world and we're just living in it. We have, starting with the war in Iran, what I call it T2 induced inflation seems to be the policy. It may relate to energy. I mean, we ousted Maduro in Venezuela in early January, and Trump couldn't get anybody to invest in improving plant and equipment initially. Well, certainly this move into Iran has caused energy prices to go up, and perhaps energy companies are going to start investing in plant and equipment in Venezuela at $100 oil. And of course, we have lower taxes and deregulation still kind of at play in terms of a policy sort of offset to this higher inflation, kind of driving incomes and the like. So we'll see how this all plays out. The bear case right now, I think, I don't know if you guys watch it or not, but or listen to it. Marco Papik, he's with BCA Research. He and there's another geopolitical analyst. Do a podcast called Two Cousins. And the bear case is that these guys were talking this past weekend. He claimed that we have 2 to 3 weeks to open the Strait of Hormuz, or we risk a pandemic level total extinction event for commercial activity. That was an exaggeration, but at the same time, we have fuel running out across the planet. We have emerging markets in trouble. We have high prices. We have efforts to conserve. That's shutting commerce down, starting to shut commerce down. And so we'll see. Trump keeps saying 2 to 3 weeks. I don't know. That's basically what Papik suggests that we have. What's the bull case? Bull case is a taco. And so everybody, the market has been particularly this week, hoping for a taco, and then last night's whatever that address was to the nation was not particularly well received by the market. Although I see we did close up in the S&P 500 after being down 1.7 or so. From a signaling perspective, what I'm seeing is lots of cross asset volatility. I have near term vol in the 30, 40, 50, 60, oil to 90. Just super high volatility. We have the VIX curve, last I checked, which is here, was deeply inverted, front end, elevated significantly. And then, of course, as we move further out in time, less concern, less stress. That said, still pricing 20 even in June, July, and we need to see this uninvert before we really think about getting long risk assets. Also have, the dollar's been breaking higher, started March 1st, basically. Oil and commodities, of course, ripping. Yields ripped right from the low end of the range to the top end of the range from, the 228 timeline line. And of course, equities, at least in my work, have pivoted bearish trend. So, and then we look at, this is performance returns since February 28th, which is the day of the first attack. And we see since that time, SPY's down 4.2%, EAFE is down 6.4%. This is as of yesterday, by the way. EEM down 8.5. I mean, these were, EFA and EEM, everybody was pivoting rest of world into the first of the year, and those were really driving strong. So this 1 month change, actually, these are minus 13% probably from the highs. Gold, of course, turned tail, down 9.49%. TLT yields 4.3 minus 4.32%. CTA, which is managed futures, down 2.05. Then we have commodities, DBC up 14.26, dollar up 2.4, floating yield treasuries, positive yield 0.27%. So, there's not a lot of safety in the risk assets right now. Hard to get long bonds, hard to get long gold, hard to get long equities. From a positioning and trades point of view, this is my positioning when we last talked on February 19th. So I was long FX. I am no longer long FX. I'm long dollar. I was long commodities, PDBC, DBB, DBA. So that was good because as we came into the beginning of March, I was already well positioned in the commodity space at least. And then long resource stocks have been very positive for the most part, although there's been a fair amount of chop, and some of those XLE has been straight up. And then I was overweight international equities. I've got no exposure there now, and overweight corporate bonds. I have very little exposure. So current exposure as of today, I'm long dollar, I'm long commodities, I'm long resource stocks, I'm long commodity trend via CTA. And then I also have about an 80% cash position in USFR bills and money markets. So looking at some of the trades that have been working, I don't mean to start with TLT, that's for sure. I want to start with the dollar. So this is the daily chart in the dollar, and you can see this is the yearly pivot in cash dollar. So basically the year opening price. Where are we here? The 2nd of January. We opened up here on the 1st of January, and so we're basically holding above that line. We were trading down below it, and then we moved up above, and so we got a nice buy signal in terms of USD. However, it was right, pricing the top of the range as it kind of made that big move off the bottom. And so I was not able to get long UUP until the 10th of March. And then I added an additional, filled out my position here on the 23rd, just over a week ago. So we're holding on to this. All of these trades are only so good as the commodity trade or the Trump I'm a warrior trade, because I think we've seen as soon as there's a taco or a perceived taco, all of these things go the other direction. So it's hard to be long and strong any of these in substantial size from my point of view. PDBC, which is commodities, this is the weekly chart, and you can see, this broke out, and we've been talking about this in the last few times I was on. We had that breakout in commodities at the first of the year. We got long commodities, and I got long, with some size here at the beginning of last day of December, 1st of January, last day of December. And then we had that nice pop into January. I was able to sell, reduce. I'm taking 10% off each time. Then we had a big pullback at the end of, this was along with the gold vol event and silver vol event on the 29th. And January, and then I was able to buy, replenish my position here back on the 2nd of February. Then, of course, the war kicked off, and we're trading at, breaking out. I'm selling 10% here, 10% there, sold 10% here, 10% there. I have about a 300 basis point position right now in PDBC, and arguably I should have added some a couple of times, but given the volatility in oil right now and in commodity space, I'm not adding. I'm taking position sizes down. GNR, which is Global Natural Resources. This was another one I've been long for quite some time. Had this opportunity to take some profits along the way. Got a buy signal back on the 3rd of March. Added some more right near my stop. My stop was right here, and I added a little bit more on the stop, and that has actually been paying. So this is Global Natural Resources, GNR. DBA, we talked about that a lot. I had gotten long DBA back in the January timeframe, and it bounced along, didn't do anything, and then all of a sudden we got this nice move up back in the middle of February. I took a little bit off, And then, of course, as soon as the Iran conflict started, DBA, which is foodstuffs, started to rise along with the cost of energy. So we are able to take some profits. I'm still holding on to 250 basis points. INFL has been a tough one. It's a very similar thing. It's inflation beneficiaries trust. ETF. I did get stopped here, but it immediately turned, and so I still have a position. I'm not fully out of the position after having taken after having added to the position on the 9th of March. XLE has been great. I got long XLE on the 30th, added on of December, added the 5th, added the 8th, and then we had all these opportunities to take a little bit off the table, 10% at a time, 10% at a time. On the 30th of March, 2 days ago, 3 days ago, Monday, we had a little bit of a reversal here, and I said I hadn't been doing much because I really taken down my exposure pretty dramatically by the middle of March, and so I was kind of sitting on my hands. My trades went from maybe 60 a week to maybe 5 or 6 a week, but I saw this move in XLE and thought I should probably take a little bit off. So I took some off on the 30th, and then I had this. We puked yesterday, and so I did add a little bit here. I thought I was going to get paid today because it was up 3.5% at the open, but it really kind of faded into the close. So we'll see whether or not I can continue to hold on to this energy position at about 200 basis points. USO, I had been long USO coming into this event. We had this big move up, as everybody knows, and I basically closed. I sold my position here, here, and here, closed it out. So I have no more USO. Arguably not the best move, but you know what? I saw. Do I have OVX in here? Yeah, OVX. I put in the volatility chart here. It's a volatility index for oil, and we had this big move. This is just so reminiscent of what took place in gold and silver at the end of January. When you have a volatility, 30-day vol at 125, I mean, it's time to really reduce position size and take some profits. At least that's the way that I operate. So that's what I did, and I'm out. And then CTA has been a tough one. It actually worked pretty well. CTA is a simplified managed futures ETF. This has been a long-term core position, but I added a pretty good size position here in mid-January. Had an opportunity, nice run, took some profits, added back, and then I got stopped. And so I took off a quarter of my position and kind of sat there because it had been operating really well so long as oil was going up and so long as bond yields were going up. CTA seemed to be well positioned for that. So I've held on to that. So I still have a decent sized position. Got a nice move today, up 4.31%, but you can just see the chop is just up and down, and two to three standard deviation events a day. Hard to hold a lot of position with moves like that. SPY. So can't help myself. I do have a mean reversion strategy in one of my accounts, and so I have been out of SPY in February in terms of my primary account, but I have a mean reversion strategy that I use. So I took a swing here when we puked in SPY on the 20th, and I had a stop roughly 2% below that number. That was sort of my limit, and of course, I took it off. It hit my stop level, which was around. I went in at 650 on the button, and 640, just below 640 was my stop. So I couldn't even get out cleanly at 640 because these were just not cooperating. So I think I sold some at 638, some at 639. And then, of course, it turned around right there. Now, whether or not that's the low or not, certainly looks like a bear market bounce to me, or at least a downtrend, a bounce within a downtrend. Went right to the middle of the range. I think we're going lower, but Raphael's getting paid at this point, so good for him. I didn't. I took a loss. One thing I wanted to point out before I turn this over to you two, I did get a buy signal right here today. This is the weekly TLT. So buy signal and TLT. I, my process says I should take a position at that point in time. I didn't take a position. Why? Because bond and stock markets close tomorrow. We have a non-farm payroll report due tomorrow. Um, I'm not optimistic in terms of the report, but there's too much risk over the weekend that I didn't want to add, even if a small position. I'm comfortable primarily sitting in cash right now. So that's where I am.
Thank you very much. Great presentation. We are very lucky that your yesterday's post was just a joke. That's for sure.
I couldn't sleep, so I thought, well, I'll do a post. It's April 1st.
Yeah, it was a good one. Yeah, that yearly pivot on dollar gave us very good trades into both sides, actually. Okay, Rafael, so you are long equities. So you think the bottom is in, or it's just a momentum play?
Hard to say for now. I need to see more to be sure. So yeah, I'm currently long S&P 500 and gold. Uh, S&P 500 for signal reason that I got thanks to my script confirmation also from your macro levels, and gold simply because we are above the yearly pivot. So I'm gonna go through the positions and also expand on the other asset classes. So share the screen. So as usual, I'm going to start with ES. Okay. So on ES, the reason why I took the long was for several reasons. The first one was very obviously my buy the dip on daily script triggered. It triggered on the same day for ES and also for NQ. So I posted it on Twitter. If you are using my script, you should have received this notification on your TradingView account. The second thing was I was watching two macro levels, specifically the first one, 642. So Vi provided this one in his trading plan video. It's with 6392. The levels I was interested to look for a bounce. So the fact that I got the buy triggered on the daily plus these two macro levels at the same place were definitely the reason why I took the trade. The upside downside ratio also on my fractal range was pretty good on that particular day. So you can see here when it happened, we are almost at the bottom of the range and pretty near a cap to the downside. So my idea was to play a bounce on the reclaim of the macro level. I got stopped out probably 2 or 3 times while trying to catch this bounce, but ultimately it started to work. So I have started to unload as the market is moving up. Especially took most of it at the flattened zone here at 6594.75. The reason why this area is quite important is because it's a previous settlement price. It's the one from the first contract of 26. So this is the reason why I took most of it. My main issue with ES, NQ, and some other stocks I'm going to go through right after is the fact that, for example, for ES, we are still way below the yearly pivot. The yearly pivot being the yearly open, where ES opened. So for now, until we start to reclaim, number one, all the previous settlement contract, settlement prices. So meaning the next one being 6796.5. I have no reason to be aggressively long. Second one, I want to see the reclaim of the yearly open. That would be these two levels would be where I would start to become more convinced that the volatility has definitely faded away and that we are getting back into a bull market. This is also confirmed here with the MFR trend. We are still below, so we broke trend and confirmed on the 6th of March, confirmed on the 17th. And for now, we are still confirming the fact that we are in a bearish trend situation. Another reason is also the volatility. You can see here in blue, volatility is still rising. You are seeing the same kind of situation in NQ. So the Nasdaq is exhibiting the same kind of pattern. We got the reject of MFR trend. Volatility is still climbing. We are way below the yearly open. The yearly open is here. And another problem for NQ, for instance, is the fact that NQ has been unable to at least reclaim the first flattened zone. We just barely touched and rejected it, meaning that for now NQ is a laggard versus ES. This is not the kind of situation you want to see if you are expecting a bull market. Let's go to Germany. Germany, same situation. Volatility rising. Every attempt to reclaim MFR trend has been a failure. CAC, same. Nikkei, same. Look at the volatility, it's rising. We are bearish trend. The only exception being FTSE actually trying to reclaim. So sure, I'm monitoring this one. It could be a one-off. But yes, that's the only exception to the case. If you go to the stocks I've been mentioning for now almost, yes, it's past 3 months, volatility is still rising. NVDA, look at the vol. Tesla, volatility still rising, still bearish trend. PLTR volatility is still way too high to invest, still bearish trend. Microsoft, same. Look at the volatility. I mean, it's been rising since November actually on this one. Then you have Amazon, same. Look at the volatility, bearish trend. Google, same picture. Meta, volatility rising, bearish trend. Apple, same picture. So, I mean, if we started to see at least some of those stocks start to reclaim a bullish trend, if we started to see volatility come down, I would feel more confident in S&P or Nasdaq started to get back into a bullish scenario. But for now, so you have to consider the bearish trend, sorry, the volatility rising. You have NQ lagging, ES. I mean, it's for me, in my opinion, I'm just borrowing a trade based on the good setup that was provided. So buy trigger on the script, macro zone retested and reclaimed as we were getting this signal, upside downside ratios that was quite good. So for now, I'm just borrowing a trade. I need to see much more before I'm committing more capital. Now let's go to DXY. So another reason why I'm not convinced that we are out of the wood is the fact that the dollar is clearly in a bullish setup. So volatility is still pointing down. Trade of volatility still hasn't reached the first minimum trade value on the daily. So you know my setup, I marked the previous historic low for trade where I can expect a reversal in volatility. In that case, volatility would be rising as trade of volatility would reach its minimum trade potential value and the XY would start to fall. So for now, we are not at mean, volatility is still pointing down. And if you look at the return correlation in UUP, look at the correlation with IWM, QQQ, SPY on a 5-day, 10-day, and 30-day. It's actually strengthening to the negative side. So meaning if dollar continue to go up, based on correlation, at least the current one and the strengthening one, there is no reason for DXY to, for stock to continue the bounce they have experienced so far. So yeah, that's another clue telling me, okay, I'm just borrowing a trade for now. Now let's go to VIX. So VIX actually is reaching its first minimum daily trade. So I have two that I have marked. I have another one, but this one is very, very extreme, very rare. So we have reached the first minimum daily trade. Okay, that's just one indication. For now, I'm not doing anything with it. I'm just monitoring. If VIX volatility here in blue start to reclaim trade, start to make higher highs, higher lows, okay, then I would start to look for more clues for volatility to start to calm down. But for now, this is the only signal I'm seeing that is appearing. I mean, it's basically nothing. So I'm not putting any weight on it. But then again, if we start to see volatility start to make higher highs, higher lows, then okay, maybe I will start to look for more clues. But yeah, for now, it's volatility of VIX is still pointing down. Trend of volatility of VIX is still pointing down. Trend of volatility of VIX is still pointing down. So as far as I'm concerned, I'm not expecting any change in the regime in which VIX is for now. Now let's go to CL. So oil, actually, I'm agreeing 100% with what Ted was saying. So here in blue is the volatility of CL, and it's getting crazy. Okay, when you start to see this kind of volatility, that's usually when you have the parabolic move, and also that's when you have the top in the near future. So exactly like Ted said, this is when we started to get the crazy move up on gold, but also when we started to enter a correction in gold. So I would not be surprised to see oil start to top in the next days, maybe week, maybe 2 weeks, but I would not be surprised even in days. So I don't know how far the move will go. When we start to sell, maybe I will be interested. But for now, I'm just thinking, okay, the top may be in, or at least it's currently developing on oil. Now let's go to gold. So this one I bought. Let's go to here, and I will explain why I took this one. So first of all, I got buy triggers. So I made a mistake actually on my first entry. Let me show you the mistake I did. Yeah. So I got the buy trigger here on the 20th of March, and I actually started to buy at the retest of the, I think it's the monthly target here. And I thought, okay, very nice. We reached the monthly target, and we're gonna start to bottom, and we're gonna go. Lo and behold, the next day I got stopped because yeah, I mean it broke, and so I was watching, and I was still getting the buy trigger on my script. So I thought, okay, definitely we are the yearly pivot. Yearly pivot again being the yearly open. I'm gonna buy the reclaim. So I entered again here, and I put more weight in my position for gold than I put in yes. The simple reason is we are above the yearly pivot. So this is something much more important than I'm getting a buy and we are at a macro level, but we are below the yearly open. We are actually retesting the yearly open. And if you are owning gold, you want this thing to stay positive for the year, right? So this is why I put a bigger position on this one. So I added actually on these 2 days on the yearly pivot and started to unload as we were moving up. So I have some levels actually in this area thanks to another script. So I started to unload in this area, and today I actually sold quite a big chunk as we were retesting the MFR trend. I'm still holding a bigger position than I have in ES, again, for the reason I have explained. For now, one worry I still have is we are below trend, and look at the vol of gold, still pointing up. Silver that has reclaimed its yearly pivot the past 3 days. So here broke it, here tried to break, still holding. Actually has this kind of volatility as well, pointing up. So I feel more confident holding gold because it's above the yearly pivot, but I'm not married to the position. I mean, I'm looking at the vol, not looking good. Silver, not looking good. Another one, platinum, not looking good in terms of volatility. So I'd like to see volatility on those start to come down a bit. I would like to see here volatility actually get below its trade of volatility and start to retest from below and start to make lower highs, lower lows. So that's what I'm going to be monitoring. I think I got a pretty good average, meaning I can buy some maybe some consolidation time in this area, but in the meantime, I really want to see the volatility come down. So yes, that's the second position I have. And again, the big reason was that I saw a question in in YouTube chat about the importance of each thing like macro zone, flattened zone, pivots. So in that scenario, for instance, this is why I felt confident to buy gold. Now let's go to Bitcoin. So I'm going to first use cash. So volatility is still very elevated. I'm interested in Bitcoin when volatility is actually below 4. Okay, so blue should be below 4. This is when I'm starting to buy. This is when I feel confident. For now, volatility is still elevated. It's pointing down, good, but it's still below MFR trend. And one worry I have is actually the Bitcoin volatility for the Bitcoin CME futures is actually not exhibiting the same kind of pattern. So I think this one is more important to watch because, for example, if you were watching cash in second half of January, you would have expected, okay, oh, maybe we are getting out of the bearish and started to become bullish. But if you looked actually at the same thing, but in for futures of Bitcoin, you were not getting fooled. Okay, so here for volatility, sure, volatility of Bitcoin is starting to point down, but the thing is, futures contract is not exhibiting the same pattern, and I think you should watch that. So again, below yearly open, below MFR trend. I mean, the yearly open is over there. Can you imagine? And now it's even below the quarterly open and the monthly open. So, so yeah, no reason to be long. No reason to be long Bitcoin. Again, I'm gonna be interested when I see two things happening: trade of volatility below trend and volatility in the fours. Until I see that, I have no reason to be interested. I don't know if it's gonna go lower. I don't know if it's gonna try to get there and then get slammed. But I can tell you something: we are not near anywhere near a change in trend. Now let's go to yields. So I'm gonna go with 2 year, 10 year, and 30 years. one thing changed since the last show. It's the 30-year. So the 2-year is still above the yearly pivot. 2-year seems to be holding the monthly and quarterly pivots. But volatility is starting to rise. Trade of volatility is actually near the mean daily trade. So could be a change. But for now, I don't think there is a reason to buy bonds, except if you are trying to deep buy them, sorry. So until we start to break some significant pivot, I don't see the reason why to be chasing bonds. 10-year is actually same pattern. Yearly open is way below. If you look at here, volatility is sure it's starting to rise. We are at the mean daily trade, but we are nowhere near breaking trend yet. And 30-year actually joined the show. Here above yearly pivot, bullish trend. Here volatility is on the floor. So being long bonds, except if you have another plan than trading, for now I would not feel quite confident doing so. Okay, so I think I've touched all the topics I wanted to talk about. Sorry, stop sharing.
Thanks, Raphael. Great as always. Yeah, when was the last time we were excited to see VIX at 24? Funny times. Yeah, good presentation. When it comes to Bitcoin, I think that if we go below 62, then we go to 50,000. This is the base case scenario for now, or we will break above 74,000 and then maybe I will be long. Okay, so let's start. I will share my screen. Yeah, so first of all, the overall sentiment in the market is still negative, and don't be too excited about that. I will just remind you that for now, the last time SPY was a bullish trend on MFR was in February, and the last time it was neutral was 12th or 13th of March, I believe. Yeah, 11th March. So for now, the base case scenario is lower. I believe that yesterday's price action also proved to us that the pain trade is actually higher. So the base case is lower, the pain trade is higher. We will see this increased volatility and big spikes up and down in the future. I'm basically almost sure about that, or at least that's what I expect. We have increased average true ranges. Yes, regular trading hour ranges. 10-day ATR is 123 points, or at least it was the last time I checked, which is crazy. If we take Globex into account, then that range is even higher. So we are definitely in an elevated volatility regime, and we need to trade accordingly, or not trade at all and stay in cash, bills, or tips, which is actually quite a good idea and is recommended for most investors currently, especially with a lower risk tolerance. So let's start with the usual suspects. So finally, we have a narrower dispersion, so a lower dispersion. Average correlations are higher. We still see a couple of sectors that are living their own lives, of course, XLE, but now more things are moving in lockstep. If you remember, for the last 3 months and more, we were in this very low average correlation regime, and correlations were as low as 0.2, 0.3. Now we had almost 0.7 2 days ago. Now we are at 0.6. When it comes to 10-day average correlation to SPY, this is the thing that I'm monitoring every single day, and actually the thing that it's the first thing I check every morning when I start my work. So yeah, now we are in a higher correlation regime, but it is still not a peak. It can go way higher. Of course, for that to happen, we need to see bigger sell-offs in XLE. We need to see the peak in oil, which for now, I'm sure we've all mixed news coming from the White House and from the Middle East in general. It's hard to expect, but at the same time, it's also hard to be long energy as well, because volatility is through the roof. OVX is at a insane levels, but keep that in mind that now if you are looking into tech, if you're looking into real estate, financials, and other sectors, now we are in the regime where weakness in the overall market will drag most of these sectors down. And of course, these rips, like we saw yesterday, these rips will also take them higher, or at least that's what was happening currently. Raphael already talked about this dollar correlation, and I believe that it's really important for now. So let's start with a 21 days, so a bit longer period correlations, and you will see these are real time. Well, market is closed already, regular trading hours, but these are the most up-to-date numbers. So SPY TLT correlation is actually strong positive at almost 0.5, and stock SPY dollar correlations are at negative 0.61, which is historically relatively strong negative correlation. So now, of course, if we need to monitor capital flows, and if this picture continues, and what is the current picture? The current picture is and basically we see this sell-off in assets. People are raising cash, people are raising dollars. I will not speculate on the reasons. We have quite a lot of those, and energy prices is not the only one. But yeah, basically people are raising dollars to pay to cover increasing energy bills, and also of course, this uncertainty. So if this continues, we will not have a good opportunity to be long equities. And same applies to precious metals and gold, gold especially, even though I'm really bullish on gold. But for now, we are in the strong positive correlation when it comes to SPY and GLD. Same happens if you look at futures and how they are moving, especially in Globex markets. You will see the exact same pattern. Now, if we go to 10-day, you will not see a major difference, and you will see that SPY UP correlation is even higher. Negative correlation, I mean, is even stronger at almost 0.8. Gold is also moving in the same way as equities, and when it comes to sectors, only XLE is basically negatively correlated to the overall market. Other sectors are maintain their positive correlation, which is of course expected, and XLE is the main reason why average sector correlations are sitting at 0.6 and not much higher. XLP has a relatively low correlation, and we saw this in capital flows since the beginning of the year. Of course, the things that outperformed were these so-called boomer stocks and defensive sectors. XLP also had a very good first quarter. So watch capital flows. Always watch what the different sectors are doing, what the dollar is doing, oil and gold. And for now, it's hard for me to recommend risk-on portfolios, to recommend buying equities just because of that. And of course, as always, before the show, we were joking a little that, of course, now Signal is not a match for Trump's tweets or truths or how you call these messages. But of course, anything can happen, and any unexpected tweet or piece of information can cause very big spikes up or down. But the base case is lower, at least for now, at least until SPY becomes bullish on MFR, and then we have a couple of important flattened zones on ES. To the upside, we have 66.58. We have 67.96, and levels in between. All these levels are available in the spreadsheet. I will answer the question about these levels that we have in chat a bit later when I'm done with today's presentation. But monitor correlations. Correlations are very important. And now we will go to ES itself. So Raphael did a very good job explaining the overall situation, but we have this scenario where we are actually above our current major level of 65.94, but the market was chopping around it for a while, and we had this big move lower, and ES reached the low of 63.53, which is more than 240 points below the level. So one of the scenarios would be the rib higher to above 6800, closer to 6820, 6840 level, to make a equally measured move to the upside before the next leg down. But actually, if that happens, we will be above both major levels of 66.58 and 67.96. So then it will be a very hard spot to initiate spots shorts. Sorry. So watch the markets. My base case scenario is lower. If I have a level of 59.40 or 60.10 where I would think that market will reach its bottom if we have a major sell-off. But of course, now one day at a time, and we need to work with what we have in front of us. So for now, something is holding this market in place based on price action, especially in regular trading hours for the last couple of weeks. It looks like market wants to go lower, but of course, we see that the result is different. Market is just chopping around for now. There is a very good explanation for that, at least from my process. Of course, is that this correlation, negative correlation to oil when it comes to equities, and oil in particular, is not allowing indices to succeed in this bullish momentum that we are experiencing almost every day in the middle of a trading session. So for now, be very, very careful. Follow the levels on the spreadsheet when it comes to ES and NQ and other indices. NQ is a bit weaker when it comes to this price action. If you open your macro zone spreadsheets, you will see that even though ES is above our most recent major level, NQ is still below. And this is, at least for now, this is the most important piece of information that I want everyone to keep in mind, because for me to become at least slightly bullish, I would need to see NQ outperforming to the upside, which of course is not the case. So gold, I will give one new level here on Market Talk. The others will be published on Trading Plan spreadsheet very soon. But we have new major level in gold, which was created 1 day ago. It's 44.92. So write this level down in gold futures, 44.92. We have a bullish bias above it, and we have a bearish bias below. Actually, I missed quite a great opportunity to buy gold on Monday last week at 41.39, which is one of our levels you can find in the spreadsheet. But then later I managed to buy some closer to 4400 level. Yeah, so I still have a small position. The area where I will be adding to my position is closer to 4850, 4900. But what I also would want to see is, of course, it flipping bullish on MFR. But the target for this move will be 5300, and if we manage to close above 52 or 5300, then we will see all-time highs in gold pretty quickly. So this is the overall bias. As you can tell, I am relatively bullish when it comes to gold, even though this correlation makes my job and managing this trade harder. But I still believe that silver is a bit a different story, but I still believe that we will have a spike in that as well. But my major play in metals is now is gold, and I will keep my position unless we close below 44.92, which is our new major level to watch. And if we stay above 44.92, I think we will see 5 handle, maybe even this month. So let's see what happens. And of course, capital flows will tell us if we are right or wrong, because if oil prices continue going up, people will have to sell everything they own again. It already happened, and it will happen again. And this time, at least when it comes to equities, I would expect even a harder, stronger move down if that happens. But of course, one day at a time, and now we have a long weekend. So we will see what the next week brings us. But this is the number, 44.92. Bitcoin futures on CME. And yes, Rafael was right. These are the most important Bitcoin contracts. So we had this attempt to retest MFR trend, and this attempt to even become neutral, but of course it failed, and the market is continuing lower. I was talking about this 50% level for quite a while, so 63,000, 62,000 area is still very important for me to the downside. But if that breaks, I don't have any really important levels all the way to 50,000. So keep that in mind. If you want to take some risk, if Bitcoin reclaims 62, 63 to the downside, which last time it happened was in February actually, then you can try to buy very, very small position, but you need to be very quick to get out, because if selling accelerates, you have to either reverse to shorts or just get out of your longs. We also have new level for Bitcoin. It will be published soon, but we are relatively close to that level. It starts with a 66 handle. So for now, nothing too crazy about that. This market needs to decide either to break below or to give bulls some momentum, which for now is very hard to expect. Overall, what I see from of the price action and capital flows, I think that the most important thing to monitor now is dollar, and the second most important one will be ZB futures together with ZN futures. If you open your macro zone spreadsheets, you will see how ZN and ZB are trading in relation to their flattened zones, and I think that we need to be reactive when these zones get reclaimed. Maybe we will get some good opportunities to buy some equities and at the same time buy some bonds, because keep in mind that we are in a positive correlation regime, at least for now. Yeah, so now I will address the question that we actually have. I will take a couple of seconds to reread that question, but basically, could you please provide an example of how you use the pivots levels at the beginning of each month because of new levels? Do you see use previous month levels on top of quarter? Okay, so I will expand on it in the next trading plan video, but I will give you a very easy to understand example. I will use Google stock maybe. But before I give, because we had a very nice setup in Google that I missed 4 days ago. But first I will address macro levels. So what never changes and what remains relevant forever are all these macro zones and flattened zones that you can find in the spreadsheet. These are for futures, so these are only applicable for futures, but futures run the world. Everything else follows. So we add new levels at the beginning of every new cycle. But simple example: if 10 years from now market will be trading at 65.94, we will be talking about 65.94 because it will remain level forever. When it comes to targets and pivots, levels, I believe you mean targets, which is the same thing. Yeah, it's a very good question, and I don't pay attention to, for example, previous months targets when we are already in the new month. Sometimes I follow previous long-term targets like annual ones, but when it comes to targets, they are time-based, and the most important ones are the ones that are currently in play. Now, example. So first of all, there is a hierarchy. I mentioned it multiple times on TradingView trading plan video, that annual are more important than quarterly, quarterly are more important than monthly, and so on. So it's the strongest targets are targets for the year, of course. So we had this setup. Another concept that I wanted to talk about is transacting in front of a level and adding on a break of a level or getting out in this case, because I had a conversation. A client once sent an email that they wanted to buy a stock, and they placed a limit order exactly at the annual downside target. I believe it wasn't stock where it had this downside momentum, but basically it reversed like $1 above the target and never reached it. So when you are interested in some stocks for option trades or for buying underlying, you need to give it a bit of briefing room. For example, this target was not reached. Technically, we had a target at 270, but the low was 273. For me, if I would be interested in buying Google, I would be buying maybe 275-ish or something, because it's relatively close. And of course, we have a lot of matchups with other levels, but it's not the case for this example. For this example, we have pivots. The most important pivots are, of course, annually. So if Google stays below 316, we are bearish. Longer term, we cannot be bullish in that stock, because it's negative for the year, and the buying momentum will increase, and new capital flows will enter the game only if we close above that pivot. Same applies to quarterly, of course, and quarterly currently we are above, but when we had this scenario, we had the previous quarterly level, which was the same as annual, of course, obviously. But so technically now in the shorter term, we can look for bullish trades, and all this is to help us to front run the signals, and to catch a trades before the big moves happen in the markets, because of course it makes sense for people to say that if we wait for annual pivot, then Google will be up $20 from where it is now, and you will miss quite a big move in the market, and this is right. So you need to look for matchups. The strongest matchups are if you are bullish on a year, if you are bullish on a quarter, and of course if you are bullish on a month. With this stock currently it's not the case, but technically you can trade against the new monthly pivot. Trading against means that if you buy it, you will get out if we close below that pivot. Now, a very important topic to mention is how to incorporate it with macro levels and flattened zones, especially knowing that these are only available for futures. So it's very easy for equities. You need to match these levels with indices, with the bias of indices. So is ES and NQ above the major level? You already know the answer from my today's rant, that ES is above, NQ is not. Okay, it would be great to see NQ also above. So are indices at the spot where you would want to buy them? Most likely not really. So then maybe a highly correlated tech stock is also not a good idea to buy. But the more the more matchups you get, the better. Now, example of a trade. So we traded. I trade breakouts, but I know that especially for annual targets, people will buy the dips also. And this tool was made for people to at least not transact in the middle of nowhere. So if you transact, at least you know where you're wrong, at least you know where to take profits, and so on. So first is example, if you buy quarterly target or close to quarterly target, let's say you decided, then you have a new pivot. Depending on your position size, you can sell some in front of that or slightly above that to pay yourself, to take some profit. You still have a remainder. What you will do with the remainder? You will ride to the next level. If market is working to your favor and is moving to the direction of your position, okay, so let's say that next target is close to here. We see this area, we have a monthly target and then annual pivot. You sell some at the here. You still, if you still have some position, then you have, depending on your conviction, more advanced way is to actually add. So you took some profits here, but if Google closes above annual pivot, you are in a good position to actually add back to your position and trade against this pivot. If it closes, you will get rid of what you just bought, but you add on the break. Same applies to so on. So this is the process. We need to always pay ourselves. This is how we will stay afloat, and also this is how we can catch big moves if they happen. Because second worst thing after holding a losing position and blowing up. Second worst thing is, of course, closing your entire position with couple of points of profit and then see that stock or whatever that is moving 100 points higher. So this process is designed for you to not make these mistakes, or at least to help you avoid those mistakes most of the times. Second is, of course, now let's say a person shorted because one day this stock closed below yearly pivot, which is of course a setup. It was bullish. It had a nice first month. So January, it actually almost reached the second target when we had this. And then it closed, this one still closed above, but then we had a candle which closed below. And let's say a person shorted it. Then at the moment you could take some profit here. Then ride your position. At least for now, I don't see in this example good spots to add to your shorts, but you get the point. And if this collapse, this crash, let's say, would continue and market would close below a quarterly target, maybe you can even add to your short position. But this is, I will spend more time with this during trading plan videos, but for me, the most important part of this question is actually how to combine the macro and flattened zone. So even though it's not an index, but it's a highly correlated, check the correlations. It's a highly correlated tech stock. So just check if indices support your idea or your trade. Yeah, so I hope this answers that question, but it's not the end. We will have plenty of trading plan videos together, but yeah, my overall view, I don't want to buy equities. I will be more happy to buy equities higher, 6,800 or higher or lower. For now, base case scenario is we will reshort below 65.94. Of course, first we need to see how next week opens. I'm relatively bullish metals in the midterm to long term, but now the most important thing is correlations, and of course, if gold closes below 44.92, this will not be in play anymore, at least till we go back to 41 handle or 39. I don't expect this market to go, gold market to go below 3,900. 3,900 to 3,800 area. But for now we are bullish. We are bullish for this new cycle, and we will see how it goes. Bonds is very interesting scenario because I have no reason to buy them, but deep inside I really want to to buy them. So of course we are not trading on based on feelings. So for now I'm not doing that, but I would really want to see ZN and ZB trading above their respective levels. Yeah, so this is my part, and for now we are like Ted said, and it was brilliant. We are trading in Trump's world, so for now we can't allow ourselves to forget it, because it's actually what it is. Yeah, so this is what I wanted to say today. Manage your risk, and hope it was useful.
Thank you, Vi. Thank you, Ted.